Hello, everyone, and welcome to this Nadex webinar, an introduction to Nadex knockouts and call spreads. My name is Todd Rich. I'm with Nadex. I'm going to be taking you through this particular presentation, and I happen to really like this one. In fact, a lot of the folks that are on this session right now, a lot of people that registered or will catch this on the recording, are new to Nadex and aren't familiar with knockouts and call spreads. A lot of people come to Nadex because we've got our binary options. I know my colleague Adam McCaden covered binary options, the basics of binary options. I think it was last week. The recording is up there. I'll show you where you'll find all the recordings of all of our content. But this particular session, I wanted to do this one this time. A lot of this has to do with knockouts themselves. It's personally my favorite product at Nadex. I think there's pros and cons to using all of our products. There's times to use all of them, but I like knockouts. And the funny thing is, everyone here is probably going to pick up the concept of knockouts very, very quickly because I think they are our most intuitive product. So let's get into it. I want to move quickly through this because I want to spend some time actually showing you knockouts as well. Before I get into anything, I do need to share this disclaimer. We have to do this for all of our sessions because all of our sessions are sponsored by our compliance department. That trading involves risk and may not be appropriate for everyone. That any trading decisions you make are solely your responsibility and at your own risk. And this is an educational session. Please do not construe anything I say today as a buy or sell recommendation. I'm doing this for your education purposes, and that will become infinitely more clear when we go over to the platform and I demonstrate how you can look at knockouts and call spreads and how you can trade them. I'm just going to be clicking around. I don't want you to take that as trading advice. By the way, a quick background on me, if you haven't been on one of my sessions before, and if you have not joined in the morning, and I will talk about that as well, because we do a live stream every morning at 7:45 a.m. Central, 8:45 a.m. Eastern, where I do this with a partner of ours, Brian Caprice from Keep Trading Simple, and we spend 15, 20 minutes taking a look at hot spots in the markets for the day. We do some live analysis for day trading, and if you're not familiar with those, I do want to make you aware of them. We do them on YouTube. I think we also stream them on Facebook, but I will show you where you can find those. If you're not able to join them live, you can always catch the recording, but it might help you focus on what's hot that day and where you might see some technical levels of support and resistance where buyers and sellers might be stepping into the markets. We just play around with charts for a little bit. So as for me, I did join Nadex in 2019. I've been in the financial services space for a long time. I spent years on the floor trading as a trader, one of those people that screamed and yelled. So yes, I stood on the trading floors. And then when I migrated off of the trading floors, I went to work for the exchanges. I spent years at Eurex. If you're familiar with European exchanges, it's out of Frankfurt, Germany. It is one of the largest futures exchanges in the world as part of Deutsche Börse Group. I worked for the New York Stock Exchange for a number of years before I was poached and headed over to E-Trade. And then when E-Trade got bought by Morgan Stanley, I moved over to Nadex. I did grow up out in California and I went to UCLA. So yes, I'm excited about the March Madness tournament. The Bruins are in there. I did get my undergraduate degree as well as my MBA from UCLA as well. So what are we going to talk about today? That just gives you a little bit on me. What are we going to talk about today? So I just want you to know what's coming up. I am going to spend a couple of minutes on who is Nadex. I'm not going to spend a lot of time on it, but I do like to do that because there are so many new people that are coming into Nadex markets. I like them to be aware of who we are and where we've come from and what we offer. Then I am going to talk about knockouts. I'm going to define them. I'm going to show you how they work. There are reasons why we've designed them the way they are designed, and a lot of that has to do with managing risk as well as managing your trading capital. So if you have limited trading funds, you can best decide how to use those funds when trading, and knockouts and call spreads are both good ways to do that. I am then going to talk about call spreads, because if you understand knockouts, call spreads will be a layup, but it's easier to understand knockouts first. And then it is going to be a practical demonstration. Now, before I get going any further, this is an interactive session. You've got me here. If you've got any questions, if I'm speaking too quickly, if I'm not being clear enough on something, please type in. You can send a question into me. I will try to monitor that and answer those as best I can as I go. And if I miss any, I will take a peek at the end and try to answer those as well before I jump over to the demonstration. And I would like to spend 15 minutes at least on the platform so you can see what I'm looking at, how people analyze different trade setups using knockouts, using call spreads, how people actually trade them. And it's important, because I think when you see it in action, it will help connect the dots, because you trade them each a little differently. So I do want to give us plenty of time to do that, but by all means, please type in questions as we go. I'd like to answer them if I can, as I should be able to. So quickly on who is Nadex, and I'm not going to spend a lot of time on this, but it is simply an acronym for North American Derivatives Exchange. We love our acronyms. It is a US regulated exchange, and we're regulated by the CFTC, another acronym, the Commodity Futures Trading Commission. Now, the reason I like to mention regulated and that really applies mostly to people who've come here to trade binary options, because there are very few, there's only a couple of regulated binary options exchanges in the United States, but there are a bunch of unregulated exchanges. You're not supposed to be able to, you're not, you can get around, you can actually access them from the United States over the internet. But if you had a problem and you needed some type of recourse, I would say caveat emptor, buyer beware, you would have no recourse. Whereas, and they do some pretty nefarious things. If you look at binary options on the internet, you'll see that there have been some problems in the past with nefarious actors, for instance, taking people's money and then not giving it back to them. Well, no, at Nadex, none of that. All of that applies to other people. We are a wholly regulated exchange in the United States. We have regulatory oversight, and we have to adhere to all laws, rules of the United States. So all that nefarious behavior simply doesn't apply to us. Unfortunately, we get lumped in because they offer binary options and we offer binary options. Now, Nadex did design contracts for retail traders. Now, what does that mean? And that is what we've got a lot of. And I mean, that's everyone who comes to Nadex, it's retail traders. And they come here because there's a low cost to entry. It doesn't cost a lot of money. You don't need thousands of dollars to trade in Nadex markets. You can come with small quantities of money. And every one of our contracts, it doesn't matter whether you're trading binary options, knockouts, or call spreads, they all have very clearly defined risk. So you know what you're getting into up front before you put a trade on, so there are simply no surprises. That is what Nadex offers, because if you trade other products, you know, your risk can be large. At Nadex, you know exactly what you're getting into before you enter any trade. So if there's any questions on any of that, please type them in, but I think everyone should be pretty clear on that. I want to get into knockouts and call spreads because I'm excited about these. Oh, by the way, if you're not familiar with this and you are at Nadex, we do have a refer a friend program. I forgot I had this slide in here. If you have a live account, you will have your own unique join code. And if you share that with your friends, and your friends sign up using that link, so you can text it to them, you can share it on social media, you can email it to them. If they sign up using your link and they placed 5 trades within 30 days of applying for their Nadex account, they'll get $100 and you'll get $100. So you each get $100. In fact, you could do that with up to 10 of your friends and you'd end up with $1,000 in your Nadex trading account. You could take that money out or you could trade with it. But people like to trade with friends. I mean, that's a lot of traders, particularly retail traders, like to bounce ideas off of each other. And here's a way where you could join Nadex. You can share your refer a friend link, and everyone gets $100, and you can trade into Nadex markets. Now, what are knockouts? Let's get into defining these and get through what we want to get through today. First of all, a knockout is a contract. All right, so all of our products are contracts. But a Nadex knockout is a contract that trades within a set range. And there are two prices on a knockout. So whenever you're looking at a knockout, it's going to have two prices on it. And it's going to give you a range. It's going to give you a low price level, which we'll call the floor, and it's going to have a higher price level, which is the ceiling. Now, the contract itself will trade between the floor and the ceiling, and it will move directly in line with the underlying. So if you're trading an equity index, the S&P 500, the Nasdaq, the Dow, the Russell 2000, if you're trading a foreign exchange product, the euro dollar, if you're trading a commodity, oil, gold, silver, you're trading the price of the contract, right? And in fact, in demo, we even let people demo trade cryptocurrency. Right now, you can practice trading Bitcoin and Ethereum with a knockout. Oh no, maybe not. Maybe not knockouts. I think those might only be binary options. Well, we're going to get to those. But with a knockout, it is a Delta 1 product. Now, when I say Delta 1, some people immediately know what that means. But the contract, the price you're trading is the price. So if gold were trading at $1,923 an ounce, the price of the knockout is the price. And it will have a floor and a ceiling, and the price of that knockout will move directly in line with the underlying between the floor and the ceiling. And it's very intuitive. It's like any other market. If you think the price were going higher, you simply buy it. You go long. If you think it's going lower, you can take a short position and sell it. Now, some people say, how do you sell something that you don't own? This is why we say it's a contract right up top, is you're not actually physically trading the underlying, you're trading a contract, and you can take a short position. If I think oil were going lower, I could sell a knockout, and if the price of a barrel of oil were to go lower, I could profit and buy it back at a lower price. So I can sell it and take a bearish or short position, looking to profit if it goes down. I could buy it, taking a long or bullish position, looking for it to go up. I simply buy a knockout, and I've got these clear ranges around it. I've got a floor and a ceiling, and I'm simply trading the actual price of the underlying. So I think that's pretty straightforward. It would be like if you're trading stock and you bought Apple stock. If you thought it was going up, you could buy it. And if you thought it's going down, you could actually take a short position. You could short stock, but there's all sorts of rules and regulations and requirements about taking a short position and shorting stock. Whereas here, you could just simply sell it. You take a short position. Again, everything's got predefined risk before you get into it. So let's get into how they work. So a knockout will expire or settle or finish in one of two ways. It will finish either by price or by time. So let's talk about that first. Let's talk about price triggered settlement, and that is what the floor and the ceiling are there for. If you buy or sell a knockout and the price of the underlying touches the floor or the ceiling, that contract immediately settles and you are knocked out of the trade. That is why they're called knockouts. So people go, why do you call them knockouts? Is because you get knocked out of the trade. Now, if you buy a knockout and it goes up and touches the ceiling, you are knocked out of the trade and you've experienced maximum profit. If you buy a knockout and it touches the floor, you will be knocked out. You're out. It's essentially a stop, and you've experienced maximum potential loss. All right. Now, you can also sell a knockout. Like I said, if you sell a knockout and it goes down to the floor, you get knocked out, and that is your maximum potential profit. Thank you very much. Now, if you sell a knockout and it goes up and touches the ceiling, you are knocked out. Now, the contract settles. So it's not like it touches the floor or ceiling like a stop order and then places an order to exit you. No, once it touches the floor or ceiling, there is no slippage. You are knocked out at that price. It settles, and you can move on to another trade. Now, you're asking, well, knockouts are initially set up to be 1 week long contracts. What happens if you buy or sell a knockout and it doesn't touch the floor or ceiling? Well, at the end of the week, it will settle. All right. So we initially have these set up as weekly contracts. At the end of the week, it will settle at a time. There will be a settlement price, and at that point, it is a time-triggered settlement. And the profit or loss on your trade at that point would be the difference between where you bought it or sold it and the price that settles. So you buy one and it trades between the floor and ceiling, never touches them. And when it settles, if it settles at a price higher than what you bought, you made a partial profit. If it settles below where you bought it, you'll have a partial loss. But remember, you knew what your maximum potential profit or your maximum potential loss were before you entered the trade. You would just have a partial profit or partial loss. Now let's. In fact, I started to already get into this a little bit as I move through it. Each knockout's got a 1 week contract. We do list 4 contracts for every market, and there's a reason why we do that, and I'm going to get into that. But there's a reason why we give you 4 choices. So for gold, there are 4 knockouts. For oil, there are 4 knockouts. For the S&P 500, there are 4 knockouts. Now, as the week goes on and a floor or ceiling is touched, a knockout, that contract disappears, it settles, and then we will list a new knockout. I will show you that process as well. So in general, there will be 4 contracts for you to choose from. And again, I will go through why we give you 4 contracts to choose from. So let's walk through an example. Here's an example of gold, and it just makes it a little visual to see how they work. So here we got an example, gold at $18.20 an ounce. All right, it doesn't matter, the price doesn't matter, and we could see where it started. And at the beginning of the week, we will list 4 contracts. Notice how and it's how we do this. And for each market, the spread of the contract varies, and we might change that from time to time based on volatility. But knockout number 1 has the highest ceiling, and knockout number 4 has the lowest floor. And so you've got a range to choose from. Now, if I were to go into this example, and let's just walk through what happens with these knockouts as gold moves. And here's the price of gold right now at $18.20. And there's the end of the week, so we know when it will actually settle. If it doesn't touch the floor or ceiling at all right, now, as time goes on, then the price of gold in this example went higher. Now, it went higher, and you'll notice it touches the ceiling of knockout number 4. Now, number 4 had the lowest ceiling. It also has the lowest floor, but it's got the lowest ceiling, so it touched that ceiling first. Knockout number 4 is done. If you bought knockout number 4, you would have just been knocked out for a profit. If you sold knockout number 4, you would have just been knocked out for a loss. Now, since that one's disappeared and gold was going higher, we add a new knockout that's a little bit higher because gold is going higher. So as they get knocked out, you'll generally have 4 knockouts to choose from. Now let's walk through the same example and say gold were to trade lower. Now, if gold starts going lower, of course, knockout number one has the lowest, has the highest floor. Knockout number one has the highest floor. So that floor got touched first. Knockout number one is gone. So if you bought knockout number one, you just experienced maximum potential loss. If you sold knockout number one, you experienced maximum potential profit. And then we add a new knockout down below. So once again, as you can see, there will generally be 4 knockouts for you to choose from. Now, let's talk about that time triggered settlement. All right. We've got an example where, in fact, I'm just going to walk through the example where, here's at the end of the week, these were the last 4 knockouts that we had at the end of the week, and gold settles at a price. Your profit or loss on, and if you had traded any one of those knockouts, because they all still exist, it never touched the ceiling or floor of any of those. I don't think, at least the way I drew it, that's what I was trying to accomplish. It traded between them, and at the end of the week, it settles at a price, and your profit or loss would simply be the difference between where you bought or sold it and the settlement price. So you can actually see if you had traded knockout number, well, I mean, it's just kind of hard to tell because you never know when you traded it. Because you don't know when you bought or sold it, but you can see what happens. It will settle at the end of the week. That's it. Those 4 contracts will expire, and your profit or loss would be the difference between where you bought it or sold it and the actual price where it settled at the end of the week. Now let's talk about why we design knockouts the way we design knockouts. And essentially, it's a built-in trading plan. And part of being a disciplined trader is to have a trading plan when you get into a trade. Now, with a knockout, your maximum risk or potential profit is known before you place the trade. And what those boundaries, what you get between your floor and your ceiling, are natural profit targets or risk control baked into your contract. So what we've done is by giving you 4 different choices, you can choose the risk reward ratio, the risk reward level that suits your comfort. You have a known profit target and you have a known stop loss. That's the basics of every knockout, and it doesn't matter whether you're buying it or selling it. If you buy a knockout, your profit target will be up to the ceiling, and your stop loss, your protection, would be down to the floor. And it works the other way if you're selling. If you're going short, your natural profit target would be the floor, and that is your profit target, and your stop loss would be the ceiling. So let's actually, when you're actually trading a knockout, when you initiate a trade, you have to put up your maximum risk. Okay, so if you buy a knockout, the cost to trading that knockout is how much risk do you have down to the floor, and if you're selling a knockout, you have to put up what's your maximum risk is if it goes up. If you're selling a knockout, it's all the way up to the ceiling. So that is what you have to put up. You put up your capital requirements are what it costs to put on the trade, the maximum risk, and we're going to get into that in a second. But we know what your risk is. You know what your risk is getting into a trade, and we know what your reward is getting into a trade. Now, from a visual standpoint, I like to show this because this is how people choose which knockout they might want to use. So this is where I take everything we just spoke about, and I'm going to show it to you so you can see it. I'm a very visual learner, so I like to do it this way. Now, here's a long example. Here's that same setup we had, and let's say you thought gold were going to go higher. All right, which knockout might you choose? Well, if you thought gold were going higher and you wanted to give yourself the most room for potential profit, and have a tight stop loss, because if you were wrong and it went down, you wanted to limit your losses, you might choose knockout number 1. Okay, so if you wanted to buy, you might choose knockout number 1. Now, you also might choose, say, knockout number 2. It's going to give you a little bit more risk and a little less potential reward, but you're going to have to make a decision on your comfort zone with the risk versus reward levels. Now, on a visual standpoint, I like to kind of show this where you can see what I mean by risk to reward ratio. And in fact, in the morning, Brian and I will often talk about the ratio of risk to reward, and Brian will show you very visually something that looks very similar to this. But here's that knockout number 1. Well, we got gold trading at 1820. We know the end of the week, and we know the floor for knockout number 1 was down at 1810. And we know the ceiling was up at 1860, and we were buying it. We were going long at 1820. So let's look, what does my risk reward profile look like? Well, my risk is the red. It could go down to the floor. And what is my potential reward? Is it goes all the way up to the ceiling. It's a green. And you can see how much risk I am taking if I were to buy this to potential reward. Right? This is what a knockout really looks like. I find this picture helps. Now, with gold at 1820 and 1810 might be a little too tight of a stop for you. That is why we offer 4 knockouts. You could have chosen knockout number 2, and if you chose knockout number 2, the red area would be a little bit bigger, and the green area would be a little bit smaller. Now, and as you can see, if I'm going to go back for a second, in this scenario, would someone buy knockout number 4? I mean, they could. You absolutely could buy knockout number 4, but you've got an awful lot of risk for very little profit. I mean, your red zone is what's below, and your green zone is what's above. So generally speaking, you probably wouldn't use knockout number 4 to go long. You'd probably choose knockout number 1, which has the smallest red area, or knockout number 2, a slightly bigger red area, if you were going long. Now, let's talk about if you were going to go short. If you thought gold were going down, you would in all likelihood look at knockout number 4 or knockout number 3. So let's look at knockout number 4 from a short perspective. All right, I'm bearish. I think gold is going down. Here, we've got that same chart where I've got the ceiling up above. All right, knockout number 4, the ceiling was, right above the 1820 level. My red zone by selling is if it goes up, my green is down below. So you can see how you would probably choose knockout number 3 or knockout number 4 for going short when selling. Because if you chose knockout number 3, your red would be a little bit bigger and your green would be a little bit smaller. So that is how people tend to choose knockouts. All right, does that make any sense? And I think I answered the question. Yes, you would, generally speaking, if you're going long, you're looking at probably knockout 1 or 2, and if you're going short, knockout number 3 or number 4. Now, there's another reason why we offer 4 knockouts, and I sort of mentioned it earlier, is your capital requirements. Since you know what your maximum risk is before you put on a trade, that is what you have to put up for your trading capital. And so, unlike trading other futures where you have to put up initial margin, and if the contract moves, you might have to put up maintenance margin, or if there's a lot of volatility, they might raise margin levels. When you initiate a knockout trade, we know, you knew before you put the trade on what your maximum risk is. Once you put that on, all right, you buy a knockout, you sell a knockout, you put up your maximum risk. That is your capital requirement, period. End of story. There will be no margin calls. You will never have a margin call. At Nadex, there are no margin calls ever with knockouts. Right? With a knockout, you never have a margin call. Okay. In fact, you don't have a margin call with call spreads, and you don't have them with binary options either. Once you've initiated your trade, that is all the money that you would ever have to put up. It is known up front. That is why it's designed for retail traders, because they're not, the exchange isn't going to come back looking for more money because market conditions have changed. And it doesn't matter whether you're buying or selling, you know exactly what your risk is. And we offer 4 knockouts so that you can manage your trading capital. If you want to minimize the amount of money you would put up trading a knockout, you would always choose the knockout with the least amount of risk. So if you were buying, you would choose knockout number 1, and if you were selling, you would use knockout number 4. So we've given you a variety of choices so that you can you can manage your risk versus reward level. What are you comfortable with? How much risk are you willing to take for how much potential reward? But it also allows you to maximize your capital usage, because you can choose the knockout with the least or the smallest capital requirement, and you can manage your trading capital more efficiently. All right, now on an order ticket, the way that you're going to look at an order ticket, there's always going to be an indicative price on the order ticket, and that is the price that you're going to be trading, right? The indicative price is the price you're going to be trading. There is going to be an expiration week. Here's an example of crude oil. Obviously, this was back. I think I did this several months back for this example, but it wouldn't matter. There's going to be a range. It's going to give you the floor. It's going to give you the ceiling. It's going to tell you it expires at 2:30 at the end of the week. So there was still almost 4 days left in this contract. But it is a Delta One product. You are trading the price. If you can see that oil was trading at the time, it was trading $70.62. Notice how that's right in the middle between the bid-ask spread. Now, if I wanted to buy, right now I could buy one at 70.66. If I wanted to sell, I could sell one at 70.59. Now, obviously, in this scenario, because the floor is so low, this is an example on where to sell, right? Now, do I have to trade on these prices? No. Can you put a bid or offer between the bid-ask spread? Yes. So here's an example. In this example, I'm trying to sell one at 70.61. Now, if I were to put this order in the market, you would see an offer right here at 70.61, and it would say 1 up in the corner, because that would be you trying to sell at 70.61, and someone could come in and potentially buy it from you, and you would have a short position. Now, if you sold it at 70.61, you know exactly what you're getting into before you place the trade, where you'd have $64 of risk. You sold it at 70.61, it could go up to 71.25, which is where you would get knocked out. And your maximum reward would be if it went all the way down to 66.25, the floor, and you can make $400. All right, that is an order ticket. It is a Delta One product. It is very clear. You're buying it if you think it's going up. You're selling it if you think it's going down. The price of the knockout's going to be, the price you're trading is going to be right around the indicative price, and you've got your clear knockout levels where you would get knocked out for at the floor or at the ceiling. Now, something I held back. If I didn't have your attention before, listen right now. An important rule when trading knockouts. Just because there's an expiration associated with the knockout does not mean you have to wait until then to see what happens. You can choose to exit your position early. Now, why would you exit a position early? You would do it for 2 reasons. You would do it to either lock in a partial profit or to minimize your losses. So if I bought a knockout and it went up, it hasn't hit the ceiling, I don't actually have to wait for it to hit the ceiling or for it to go to the end of the week. I can simply sell it back and take a partial profit. Thank you very much. Move on to your next trade. If I buy it and it starts going down and I decide I don't like this anymore, I do not have to wait for it to hit the floor. I do not have to wait for it to hit the floor to get knocked out for maximum loss. I could simply sell it back out and experience a partial loss. So that is very important when trading knockouts. You do not have to wait until expiration to see what happens. You are allowed to exit a position early if you want. Now let's talk about call spreads. This will be a little bit quicker because once you understand knockouts, and are there any other questions on knockouts? I think I answered all of them. If you're all good with that. And by the way, if you want to see specific examples, go ahead and type in a question. When I jump over to the platform, I'll look at that market. So if anyone wants to see the S&P 500 or NASDAQ or gold or oil or whatever, just type it in and I'll try to show an example when I go live over to the platform in a minute. I'm more than happy to accommodate that request. Now, call spreads. These are going to sound very similar to knockouts in that a call spread is also a contract that has a predefined range. It also has a floor and a ceiling, and a call spread will move in line with the underlying, very similar to knockouts. Very similar to knockouts. However, there are two very big things that differentiate call spreads from knockouts, okay? And that is, number one, a call spread differs from a knockout because a call spread only expires at expiration. There is no price triggered settlement. Now that is important. So with a call spread, unlike a knockout where you are knocked out of the trade, right? You get knocked out. A call spread can go through the floor or the ceiling and you are still in the trade. All right. It has optionality baked into it. Now, because of that, a knockout is a Delta One product. You are trading the price of the underlying. There it is. What you see is what you get. With a call spread, volatility and time to expiration are going to impact the price of a call spread. So when you look at the price of a call spread, it is not going to mirror exactly the price of the underlying. There is going to be a premium baked into it. All right, that is because there is optionality. If you hit the floor or ceiling, there is going to be a premium, and that premium will expand or contract based on how much volatility there is in the market and how much time to expiration. Because of that, people tend to trade call spreads differently than they trade knockouts. And I will show you that when I jump over to the platform. Now, an order ticket on a call spread. Here's another short on a call spread of oil. I've got the indicative price. It's 70.60. So, and there were 18 hours left. And I've got my floor and my ceiling. Now, remember, this is a call spread, not a knockout. So when you look at the prices, well, I could see oil. If I wanted to go short this contract, it's trading at 70.60, but I would have to sell it all the way down. In the middle of this range, I could try to sell it at 69.73. That's below where, you can see how it's not Delta One. That is the premium it's going to cost you. If I were buying it, and if we looked at a knockout call spread contract, when you look, it'll be the other way. When I try to buy one, it will be higher than the price of the indicative. But I know that if I were to sell this, I'm selling this contract. It's at 70.60. Notice the ceiling is 70. I'm selling this call spread and it's above the ceiling. Right? With a knockout, I couldn't even do that. With a knockout, you can't. The ceiling's got to be above the price. With a call spread, I can sell it and it's above the ceiling. Now I know if I were to sell it at 69.73, the most I could lose is $27 because 70 is the ceiling, even though it's currently trading above there. And if it were to trade all the way down to the floor, I could potentially make $473. But remember, if it went all the way down to 65, I'm not knocked out. It could go to 61. I'd still be in the trade. All right. And that is why, and once again, an important rule when trading call spreads, you do not have to wait till expiration to see what happens. So for instance, in that previous example, let's just go back. If I sold this call spread, and I mean, if oil did go all the way down to 65, all right, and it went to 64.90, it's below, at that point, it would have traded from above the ceiling to below the floor. I'm still in the trade. In order for me to close it, I would have to buy it back or wait until expiration. But by then, it might have gone higher. And at that point, I will have experienced near maximum potential profit. I probably would have been darn near all of that. And at which point, you probably would have wanted to close it and taken your profits and walked away, because at that point, the risk of it going higher and any potential remaining reward probably wouldn't be worth it. So it's important to understand that with both knockouts and call spreads, you do not have to wait until expiration to see what happens. Now, with that, any questions for Nadex, please email us, customerservice@nadex.com. Follow us on social media. I want to emphasize the YouTube channel. And in fact, I'm now going to jump over to the platform. So if you've got any other questions, I've already got a couple of products. The winner, the first one in was the Dow. So I'm going to start with examples of the Dow. But if anyone else would like to see something else, I've got a couple other ones I could try to do. Maybe I could jump over to call spreads for one of these other ones. But let's start doing. Oh, by the way, before I do a practical demonstration, I did want to come to the Nadex YouTube page. If you're not following Nadex on YouTube, you simply go to YouTube. You can search for Nadex. Up here in the bar, you'll find Nadex. You come to the Nadex YouTube channel. We do have a lot of content that is posted up here. All right, you can catch these videos. This session will be posted up here at some point. If you go to the videos box, in fact, you will find that's where you'll definitely find this. You will find a recording this, plus you'll find it on the Nadex website in the learning section. But every morning, I mentioned we do a live stream. Here's the live stream from this morning. If you wanted to see what we spoke about, you can go back and you can play this. Our CEO does a quick 1 to 2 minute update in the mornings, but you can catch all of these. Now, I'm changing this from uploads. I'm changing this to upcoming live streams. I usually have them out a week. You can, if you subscribe to our channel, and I would recommend subscribe. You'll know when new content gets posted. You can also, if you're subscribed, you can set a reminder for yourself that these are going live every morning. I'm in Central, so you can see it says 7:45 a.m. because I'm in Chicago, but it's 8:45 a.m. Eastern. I do this with Brian Caprice. These are the upcoming ones. If I go to past live streams, you can go back and listen to what we had. You can see we do this every morning for 15 to 20 minutes. So if you're not able to join us live, you can watch the recording. So if you wanted to hear what we had to talk about today, and you want to know what we do every morning, you could play today's or yesterday's, and you can see, are we providing some valuable information? We've got a following. It is very useful. It does help you look for hot spots in the markets for that day. We cover headlines. We cover economic events or any reports that are coming out. We take a look at the charts in those hot spots, and we take a look at technical levels. So we're just trying to help you. We can't give you trading advice, but we can certainly tell you what's going on in the markets before they open, and at least the equity markets open, to help you in your trading journey. All right, enough about that. I am now going to jump over to the platform, and let's do some demonstrations, okay? So let's go back to, all right, so this, I'm going to do knockouts first, all right? And if you're looking at knockouts, I'm in knockouts, right? Binary options, call spreads, knockouts. And I said we were going to do let's go to indices, and I'm going to go to the Dow, okay? And I'm just going to click on any one of these four. It doesn't matter which one I pick. And the reason I say it doesn't matter which one I pick, because when you're looking at the chart, you'll be able to see all 4 knockouts. They are clearly, and you can cycle between them. Now, if I wanted to take a long position, I would probably choose I call it knockout number 1, the one that's got the lowest floor. And you can see we've got very clear floor and ceiling levels. And if I were going to buy this knockout, I know where are we? Here we go. There we go. Okay. Yeah, there it is. 34,205. 34. Yeah. God, it's just weird for me to look at the prices just because the Dow is but I can see where my maximum, if I were to buy it at 34,207, I could see my maximum losses, it goes down to the floor. My maximum profit, it goes up to the ceiling. If I were to choose a different knockout, notice how my levels change. I mean, if I were to buy knockout number 4, I can't even buy knockout number 4. No, let's just look at this one. Knockout number 3. If I were to buy knockout number 3, I could only make $76 from here. It can only go from 34,107 up to 34,209 and to the downside. So I wouldn't buy knockout number 3. If I wanted to go short, on the other hand, I see the Dow's rally. Maybe I think it's going to turn around. If I wanted to take a short position, yeah, it's $1 away. This is about to knock out. In fact, if we're sitting here long enough, in fact, I think, did it knock out? No, I mean, it's getting close to where it will knock out. If I were to go short, I would probably choose knockout number 3. And I could see if I were to sell it, I know that my maximum loss, if it went up to the ceiling, would be $92. And my maximum profit would be it dropped all the way down to here. I was actually trying to do an example in the S&P, and I was trying to set us up for one earlier. And before I went on, and clearly the markets have rallied, because I wanted to do an example, and I said, I bet the market's going to rally while I'm looking at it. You could see the 4 knockouts. The knockout, the one that I bought earlier, yeah, I'm doing all right on it. You can see that I bought it down at 43.56. It's now up at, and I've got one on. Now, I'm going to show you something that this is some great functionality. If I've got a position and I want to get out of a knockout early, all right? So, I mean, this knockout, I've made a profit, all right? This is great. I made a profit on it. I can click on that, and it will set up a pre-populated order ticket for me to go and just try to sell it right now, or I could try to adjust what price I want to sell it at, all right? I could simply go to close and hit close a position, and it would send a market order, and you could see exactly what would happen if I just sent a market order. Or I could set a profit target. All right, if I click set a profit target, now I can see that it's currently trading at 43.75, 20. Maybe I want to put it a little bit higher. Maybe I'd sell it 43.76, 43.77.20. There we go. Whatever. I could place a limit order above the market. All right, and now you can see I've got an order to sell it higher. Now, at this point, I've done pretty well. So let's go ahead and cancel. I'm going to click on that and delete my order I just placed. And yeah, you can take profits. I could, it's going my way, but if I just wanted to close it, lock in the $200 that I did from earlier, I'd close the position and boom, I'm out. Thank you. And I move on to my next trade. Let's do a knockout on a commodity. And by the way, yes, this is being recorded, as I mentioned, and it'll be on our YouTube page, and you'll get an email when the recording is available. Let's take a look at gold. Here's gold. I'm going to click on gold. All right, I've got no positions right now. Let's just make the chart a little bit bigger. Let's just, yeah, I think we could stretch this out a little bit. And, maybe I think gold's going to be going lower. All right. It looks like we had a knockout that didn't get erased off the charts there. And that's strange. Well, maybe, no, I know why. This one got knocked out. So now we've got a variety of gold knockouts. All right, so if I wanted to go short gold, all right, here we go. I think gold's going to keep going lower. Do I have to sell it at 1942.90? No, I could. I mean, look at this. It's a dime. I could maybe sell it at 1942. God, I want to. There we go. Place my short order. There's my one lot. Trying to sell at 1943.1, and I just sold it. Okay. So now I sold it. You can see my position here. This is, again, not a buy or sell recommendation. I know I sold this. I know I can't lose any more than $49. I can't lose more than $49 because if it goes up here to the ceiling, I'll be knocked out, and I've got 1 day. Now, I can make 151 if it goes all the way down to the floor. Now, what could I do? I mean, if I didn't like doing that trade, I could quickly close it and just take $1 loss. Or I could have clicked on this and try to place an order to sell it. Maybe I could probably scratch my trade. But let's say I want to set a profit target. All right, I sold it, so I want to buy it back lower. I can say, you know what, maybe I want to take this for a $50 profit. If this went for a $50 profit, I'd take it. All right, and you can also just type in a price. So 1934.50. Oh, I put 18. That's a typo. Start all over there. 1930. There. 1935, whatever. Okay. So it would be an $81 profit. $81 profit target. Actually, let's put this higher. The floor is 1928, so let's go to 1938. Okay, a $51 profit target. I placed my order. All right. I mean, now I sold it and it's gone higher, but I've got a profit target down below. I'm trying to buy it back down below, so it doesn't have to get all the way down to the floor to knock me out. I've got an order to buy it back a little bit lower, and I can, if I walk away and I have to, go run errands, go to the grocery store, if it went up to the ceiling, I would be knocked out. If it came down to my floor, I'd buy it back. Now, I do have to be careful. If I get knocked out, I would have to go and cancel my order down below. But that's my profit goal below. But if it came down here and I bought it, boom, I'd be out of my position. Now, that is how people trade knockouts. Right? You're generally, when you're looking at knockouts, let's take a look at Nat Gas. Here's 4 knockouts. When you're trading knockouts, generally speaking, if you're looking to buy, you're trying to find one where it's near the floor so you can minimize your risk. Maybe I'm willing to take a little bit more risk. So you got to manage your risk reward profile. If I'm selling, I'd probably sell one that's closer to the ceiling. What did I click on? There we go. So again, I've sold it. I'm trying to minimize my risk because if I sold it and it were to go up, I'm trying to maximize my potential profit. And again, you'll see how the knockout, it will trade very closely in line with the indicative underlying. Now let's take a look at call spreads on the other hand, and let's see how, yes, and I will adjust the chart, okay? In fact, thank you, I appreciate the comments. Let's make the chart a little bit bigger, and let's look at call spreads. And I'm going to go back to call spreads. Now notice here, let's refresh this. Notice here we've got a bunch of different expirations. All right. Let's look at commodities. Oh, let's actually, you know what? I'm going to take a look at Forex. Yeah, let's do it FX because it does have a longer dated contract. So let's say we were looking at the euro US dollar. We're looking at a call spread. I'm going to go to the weekly call spreads. All right, I'm going to bring up any call spread right now. Now we've got different ranges on call spreads. When you click on a call spread, you'll see the shaded region, okay? And this is how you'll actually be looking. If I were going short, okay, it's the euro US dollar is rallying. Okay, let's go to a 30-minute chart. All right. So now I'm on a 30-minute chart. It's rallying, and I think I want to go short. I'm going to click the red, all right? Now let's see where I might choose this call spread. Now, why would I choose this call spread? I'm going short. Notice how there's 1 day and 2 hours left. If I were to sell this, right now I could see that it's currently trading well above the range, but my loss would only be seven. I mean, I'm risking $7, and I'm looking for it to come lower. Oh, I don't want to do that. I want to still see the whole range. All right. I know that the floor is all the way down here. You've got to find one where the risk reward makes the most sense to you. For instance, I mean, because selling, I mean, here's one where I'm in the range, and you just have to take a now. I mean, look, am I prepared to take $178 of risk for potential five? I mean, is it going to really go all the way down here? I doubt it. But you've got to find the range, and you'll see some of these are smaller ranges, some of them are larger ranges, and you'll have to take a peek. There's standardized ranges for the commodities, but when you get into the FX markets, we've got a bunch of different ranges. And if you were going to go long, you've got to find, and when people look to buy a call spread, they'll often look for one that's near. Let's find a different call spread. These are all going to go lower. If I wanted to go long, this might be my only choice at the moment, where it is in the range. But often with call spreads, what people will look for is buying just below or near the floor. And remember, if it goes through the floor or it's below the floor, you're not knocked out. You've got time for it to go up, but you're going to have to pay a bit of a premium. There is going to be a little bit of a premium that you pay. I mean, buying this one right here, if I were to buy this at one spot 1131, you can see how it's already trading at one spot. You're paying above the price of one spot 1125. Right? That's where it currently is. It's one spot 1125. We've got extra in there. So I am actually paying above where it's currently trading. That is the premium that you're paying when you buy a knockout, or you're going to sell below. But you can see how knockouts are a little different. Hold on, I'm trying to read a quick question. Oh, you know what I can do? I can tear, by the way, I'm tearing off the order ticket, and I can hide this, and I'm hoping that you can see this. This is actually just functionality on the platform, where if you've got, by the way, hopefully you caught what I just did. You can tear off your order ticket, and you can tear off your charts. And if you've got multiple screens, you can have multiple charts and multiple order tickets open all at the same time. And you can maximize and you can manage your screen real estate how you see fit. So I've been just keeping the platform, the setup as a default. I could also tear off my chart. And if you had multiple trading screens, you can see how I could have multiple charts open. I could have, oh, where's my order ticket now? I just closed the order ticket. I messed that up, but you can see how you would have multiple order tickets, multiple charts on your screen so that you can maximize your screen real estate. All right, so hopefully that made sense with what I just said. All right, because I got it, but for simplicity's sake, right now I've kind of got it. I want everyone to be able to see everything that we're currently doing. So again, now here's the Aussie dollar. Here's a good call spread example. If I were going to go long, all right, if I thought the Aussie dollar were going to keep going higher, notice how the price. Now this has only got 2 hours to go. But you could buy this. My risk is a whopping $7. And do I think in the next 2 hours it's gonna pop this much? Maybe not. But you can see how you can manage your risk reward with call spreads, and you can get into this trade for $7 if you thought the Aussie dollar were going to tick higher in the next two hours, and you're paying a slight premium to do that, and you're not knocked out if it were to go and touch the floor. I mean, in fact, it's trading right near the floor as we speak. All right, I went a little longer than I thought, but I wanted to spend some time showing you the different nuances between call spreads and knockouts. Call spreads have that functionality, the optionality, where you do not get knocked out, but you are going to probably want to exit the position early. I am a big fan of knockouts. I really like knockouts. I think they're our most intuitive product. You're simply buying if you think it goes up. You're selling if you think it goes down. It is a Delta One product so that you can, I mean, you're trading the price. The price is the price, and you're simply managing your risk by choosing a knockout if you're going long or short that makes the most sense for you, right? So that you can manage your risk accordingly. If I were going long, I'm going to choose a knockout with the highest floor. If I were going short, I'd choose a knockout with the lowest ceiling, again, to minimize my risk, maximize my potential profit. And again, you do not have to wait until expiration to see what happens. You can exit a position early. With that, I want to thank everyone for joining. I want to remind you again, go over to YouTube and subscribe to the Nadex YouTube channel, and also set alerts. Join us in the morning. We'd love to have you. You can type in questions then. We interact with folks. But if you're not able to join us, you can always watch it later and catch the analysis we did every morning. Hopefully, I will catch you again tomorrow morning. In the meantime, thank you for joining this. You will get an email about the recording, and good luck in the markets.